Meantime, Treasury yields continuing to slide today, with the 10-year hitting its lowest level since early April. The latest move coming as investors await Friday's jobs report. But where are rates going from here? For some answers, we bring in the man with lots of charts, the chart master, Carter Braxton Worth. Hey, Carter.
Hi. Yeah, I mean, look, I'm in the lower rates camp, and yet maybe there's no camp to be in. Before we look at the charts, the truth is higher hasn't happened. Lower hasn't happened. We're just stuck here in the mid fours. This chart that you see on the screen, we're right now exactly where we were in October of 2022. That's 20 months ago. At that point, we had just spiked from 2.5 to 4.3 in 3 months, and higher for longer became a mantra. But it's not been higher for longer. It's been no change. And so the question is ultimately, I think we're in the peaking process. These lines would suggest, to my eye anyway, that we're going to break trend. Let's look at a few more iterations. It's all the same chart, one after another. But if you look at the next one, you'll see here that 20 months, despite that slight blip above 5%, interest rates are not higher, not on the 10-year, and there's just no way around that. And it's a good lesson for all of us when something becomes a mantra to typically consider it suspect. Let's keep going. Next chart, and they're all the same. It's the same time frame, but just drawn a different way. The down arrow is a judgment. That's mine. Other people are thinking, and I have a lot of clients that push back on the note again today, saying, you know, when the buyers step away, the Chinese and the Japanese and the federal government, we're going to have a big problem. The bond vigilantes are coming. I can't speak to that, but my hunch is lower. Let's keep going. I think I've got one or two more ways to draw the lines here. It's all the same chart. We broke that minor trend that you see today. Again, 4.32, lower than where we were in October of 2022. It's June of 2024. I think we might have one more. It's all the same chart. It's just different ways to depict the situation. Falling back below that horizontal line is not good if one is bullish of yields or thinking yields are going higher. Maybe one more, I guess there is, and then that's it. And so I think we break this formation. I'm a buyer of long-dated treasuries.
Hey, Carter. It's Karen.
Hi.
So if we break that line, where do you think the next stop is?
Well, see, that might be the seduction, right? Maybe it isn't meaningful there. One could say, well, my goodness, you're thinking 2%, 3.25%. It's very possible that the whole rate conversation, right, isn't productive in the sense that maybe this is the proper level for 10-year treasuries, and that the work of CAPM, right, and dividend discount models and discounted cash flow should disregard this, and that the securities analyst, the portfolio manager, should go back to the job of trying to figure out 2 to 3 year future cash flow and discounting and putting a price target and not extrapolating 7% on the 10-year, 3% on the 10-year, because it turns out the 10-year is the same level it was 2 years ago. But as to how much lower, I think we're going into the high threes.
Carter, it's Tim. It's hard for me to argue that, especially if we get some of the economic turnaround, that rates aren't going to come lower. And at least that's not the first move. And I do think there's this whole setup of less central bank buying. I do think there's a deficit to finance that's a very different story. How can you argue that rates haven't gone higher since July of 2020? And I realize you can pick spots since, you know, you can find spots in October of 22 or back in 22. And I'm picking a spot, too. Like, I'm picking a low spot. I recognize I'm buying in the low spot. But I can draw a trend line all the way there that has not been violated from July of 2020. So I don't want to get here and try to get out there and die on the hill if I think rates have to go over 5% tomorrow. But I think rates have consistently crept higher with periods of a lot of volatility.
Well, they have. I mean, we know that from the low of COVID, when the cost of 10-year money was almost zero, we're up meaningfully. We're up 5x, right, from those levels. But the point of this exercise, at least as I think, that spike high in October of 2022, we'd essentially gone from 2.5 to 4.5. That was the low for the market, right? The S&P at that point in October 22 was down 27%. We were in a bear market. The Nasdaq 100 was down 37. But the extrapolators at the time, that's when higher for longer became, well, my God, if we've just gone from 2.5 to 4.5, what about 6.5? And it turned out that was completely not right. And it's not about being wrong and right. It's just that rates really are not meaningfully higher. Yes, over the past 3-5 years they are. But and this is there's no way around this, is 10-year money at 4.5%. Is that a bad thing? Is that a bad thing for valuation? Of course it's not. In any other era, that would be considered nirvana.